In this week's update, stock and sector selection has never been more critical, and caution is absolutely warranted, and more mega deals in lithium. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Let's start with our normal market perspective. What's bothering me a bit at the moment is the lack of US market breadth. Yes, the indices are advancing, particularly the Nasdaq, but the leadership is very, very narrow. It's not normal, and it's not particularly healthy, beg your pardon. You want to see, at this stage, the advance much more broadly based. So I'm a bit nervous, a bit skeptical about what's happening in the US market, and hence the sentiment for the rest of the world. So if I can sum it up, I'd say my confidence in indices is low, but my confidence in selected Aussie stocks is sky high. There really are some fantastic opportunities in the Australian market. If we look at the US market, we've got a battle going on between the fact that stocks are falling, many stocks are falling because of a slowdown or a fear of a slowdown. And on the other side, we've got upward pressure on some stocks because the market is anticipating an end to the rate cycle. So does a recession mean the Fed backs off sooner and reduces rates sooner? Probably. How does the market react to that? No one knows, because it's a sentiment-driven thing. So that's the battle at the moment. Who wins? I think, as I've been saying for quite some time now, that you really want to stay with stocks where the earnings certainty and earnings growth is as strong as you can get it. And if you can do that, then you're on a reasonably solid footing. Doesn't mean that the stock price can't fall, but it does mean that the stock price will almost certainly rebound fairly strongly. The US financial system, is it out of the woods? That was the question I posed last week. I think it's most unlikely, and we saw another regional bank in the States, PacWest, under very severe pressure. 10% of their deposits were gone in a week, and the share price is getting absolutely crucified. More broadly, the debt ceiling debate is, or you wouldn't even call it a debate, it's a standoff, is a complete shambles. It's an indictment of the American political system that this regularly keeps popping up. I guess at the 11th hour, it'll get resolved somehow, and the US government won't get shut down. But look, it's all unnecessary, and it just makes the markets nervous. We've also got recession fears, which are either a possible recession or recession is a done deal, which increasingly seems to be the case. So I think this is a time to be super cautious on selection, on where you're entering. You certainly want to be entering on weakness. You don't want to be chasing prices, and you just need to be very clear about your game plan and what you're doing. So tricky market at the moment. Let's look at the American stocks. The S&P was down 0.3% across the week. I think it was down 0.8% the previous week. We've got the economic data, which is weakening. We've got the regional bank situation, the debt ceiling. It's all creating nervousness. But through all of that, we've got the Nasdaq at an 8-month high, which is pretty amazing. And I'll show you a chart of Google in a minute that really, I guess, underscores what's happening in the US market. It's the outperformance of stocks like Google and Apple, and to a degree Amazon, that is basically driving the indices. So if you want to just look at the indices, you're really getting a completely erroneous picture of what's happening across the broad US market, because the leadership is just very narrow, and as I said right at the start, not healthy. US dollar index was up a little bit. Thursday and Friday were quite strong days. 102.69. We saw the 10-year yield pretty much steady at 3.5. The VIX also pretty steady around 17. So there certainly is an element, given all the potential problems, there's an element of eerie calm in the American market, if I can put it that way. The 10-year, 2-year spread is still sitting around about 0.5%, and it's been flashing recession now for, I guess it's probably nearly 12 months. Let's get to the charts. We'll start with the NASDAQ, and you can see we've got a really nice breakout, really nice uptrend. All of your moving averages are all stacked up in the right direction, and the index value is above all of them. We're approaching some resistance. I'm not sure what that really means for the indices, to be honest, but just for the record, we're approaching some resistance up there on the NASDAQ. But look, that strength is being driven particularly by stocks like this, by Google. And you can see we've had a very, very strong surge in the latter half of last week. Apple also looking very strong. So that's the overall US market. Let's look at where the individual money is going, or we'll have a look at the S&P first. So the S&P, as opposed to the NASDAQ, is just going sideways. NASDAQ trending higher, S&P sideways. And if we look at, let's go to the spreads. So this is the weekly chart, large cap growth versus large cap value. Obviously, the Googles and the Apples are contributing strongly to this chart. So it looks impressive, but it's not as impressive as it would seem. I would like to see a lot more participation from other growth stocks as well, not just the mega caps. So that's hence my caution. US semiconductors versus the S&P. Yeah, pretty much a neutral week, but still medium term is setting higher highs and higher lows. NASDAQ versus the S&P, as we can see, is still setting higher highs and higher lows. But this is the key one for me. So this is the NASDAQ versus the Russell 2000 for small caps. And you can see that the NASDAQ is outperforming massively, or if you look at it the other way, the Russell is underperforming. So that's the relative chart. And then if we look at the Russell itself, it's looking pretty drab. And it's if anything, it's pointing a little bit to the downside. We've got a bit of a downward bias there, and it's not looking particularly healthy. So that's my concern with the US market. The Aussie market, our dollar finished under 66. The index was up 0.5% across the week. Looking at the bank's earnings results, and I'm sure you've read plenty about this in the last couple of weeks, but it's highly, highly likely that Australian bank stocks have seen their peak earnings. That doesn't mean that the share price can't go up, but what it means is that it would have to be expansion of their PE ratios that would be doing the work, and that at this stage of the cycle is very dangerous for the PE ratios to be expanding. So I don't think you should have very much expectations around the bank stocks continuing to move higher. Through the week, we also saw weak Chinese manufacturing and consumer demand, so that's obviously a concern for a lot of parts of our economy. But small caps really starting to get a bid now and looking much better. So that process of, as you come out of a bear market, the leadership is the large caps initially, and then it starts to filter down, and we're seeing quite a few areas, and not just mining, where the small caps are starting to rise to the top. Right, let's just take a quick look at the Aussie market. So there's the ASX 200. Not a lot happening here, and we're still at the same level that we were at in May of 2021. So 2 years, the Aussie index has done nothing. If we look at materials over that same period of time, you'll find that it also looks almost exactly the same, which is no surprise because materials and bank stocks tend to make up a big percentage of our overall index. So if we look at finance, we should see something quite similar. So we've got to go back to, a little earlier, so it's about 26 months on finance. But if we look at energy, and energy nowhere near as impressive in Australia as it has been in America. So if we go back to May of 2021, that gets us in about here. You can see energy has done better, but as I said, nowhere near as well as the States. Pardon me. Turning to precious metals, gold down $9 to 2011. Plenty of buying support, despite the fact that the US dollar moved quite strongly higher on Thursday and Friday. Yet the gold price wasn't off very much at all, and I think actually went up slightly on Friday. So that equates to a premium for fear, and that makes sense because there's plenty to be concerned about in the market at the moment. It's also higher in Australian dollars, 3,056, so very profitable for Australian producers. Looking at GDX on a global basis, pretty boring. Not a lot to get excited about there, but there's certainly in Australia, particularly with gold developers, looking much, much better. So let's just have a quick look at those charts. This is the weekly for gold. You can see down a little bit, but still holding on to this fairly important support around 2,000. And there's gold on a daily. And if we look at silver, silver really did come off very, very hard on Thursday. So US dollar, you can see this is US dollar on a weekly chart, quite a strong move, but most of that was Thursday and Friday. And just completing the picture, there's the Aussie dollar. GDXJ is pointing in a positive direction, so the moving averages are up, but it's not terribly exciting, I'd have to say. And we're seeing a lot more potential upside in advanced developers, particularly those with world-class deposits. Turning to other commodities now, copper was down with the combination of the currency effect and also recessionary fears and the data coming out of China. Nickel also dropped about 10% on the week as well, so pretty big move. A key issue that is really starting to become obvious now is the conflict between environmental and social considerations around mining and expanding mining and the need for critical metals development. And it's hard to know how that one's going to clarify because the really zealous climate activists, are demanding more in the energy transition, but an essential part of that is the development of critical battery materials. So I don't know how that one's going to resolve, but it certainly, for sure, is slowing down the supply response, and so we are almost certainly destined for higher commodity prices because supply, even if there weren't barriers in regulations and other hindrances, supply was always going to have trouble keeping pace with demand. But these other restrictions is just going to slow it down. That's going to mean higher commodity prices, higher inflation. So we're in an incredibly precarious position with respect to financial markets, I believe, for years to come, and that's why it's just so important to be very clear about what you're doing. Crude oil, 70.1, not a lot of change there in the week, but I do note China imports were down 16% in April, which is pretty significant. Looking at other commodities, lithium prices I've been talking about. I've created a spot for them in this presentation for quite a number of weeks now. Lithium prices certainly confirming the contrarian opportunity that I talked about 3 or 4 weeks ago. The rebound started with local stock prices in mid-April, and you may recall on the 23rd of April, I said it was time to put our contrarian hats on, that the sell-off in lithium stocks was totally overdone and we were close to the bottom. And it turned out, with the benefit of hindsight, that the bottom was the week before. And then on the 30th, I said that there was a momentum building in copper stocks, and that is still a bit stop-start at this stage, but there's definitely some improvement in the copper space. But particularly with lithium, I was talking about just the fabulous opportunity that exists in lithium. And we've got acquisitions, we've got lots of mineral resource estimates being declared, stocks that have got an X factor that are going to come into the sights of bigger players for a takeover. So, that's something I've been focusing on in Portfolio Analyst, is identifying the stocks that have got the X factor, because whether they end up attracting a takeover offer or not, they're going to get a premium. The market is going to give them a premium price in anticipation of a likely takeover. And I think you're going to continue to see that accelerate. So there are hundreds and hundreds of lithium stocks, gold stocks, copper stocks. It's so important to identify the ones that have got that X factor, because there's not enough money in the market to support them all. Not everything is going to go up. It's just going to be a small number of stocks that really are the standouts. So, look, the bottom line with all these battery materials stocks is that demand is being constrained by supply. It's not demand itself. The only way to fix a supply issue is for companies to explore and find more, or to acquire or acquire. So I think this acquisition cycle that's just going to filter down the line is just going to build and build in momentum. So very exciting period, not only for lithium but for other battery material stocks. But certainly lithium is the one that's really got the market excited again now. So I think it's a given that we see improved product prices, which means a lot more money for exploration, a lot more focus on acquisitions. So it's just all snowballs. And you can throw on top of that potential supply disruptions in South America. Certainly, Chile is looking pretty iffy. Peru has certainly been making noises that aren't mining friendly. We've got inflation in Argentina that's absolutely off the charts, and likely political instability there as a consequence. And so how all that flows through to government policy remains to be seen. But at the very most, some companies, I think I read through the week that Rio is holding off with some development in Argentina because inflation is running so high that it would just blow out the cost of the projects. So the situation in South America is not helping. It's all leading to a reduction in supply or a lack of expansion in supply to meet the demand. The small caps are the exciting space for me. So expect to see a lot more activity in that area. There's the copper chart, a little bit higher in terms of the warehouse levels, but it's not the warehouse levels that created the price during the week. It was the combination of the US dollar spiking up and also what's happening in China, or what's not happening in China, more to the point. There's the nickel chart showing a pretty big dip through the week, but no response from nickel stocks. So nickel stocks still falling. So that's going to keep some buoyancy in the nickel price, that's for sure. All right, wrapping it up, the Aussie market is pretty typical of the situation that we've got at the moment, and that is that if you've got a diversified portfolio that looks something like the index and behaves something like the index, it's giving you nothing. And it's been giving you nothing for 2 years. So, and you know, with all the headwinds that markets are facing, I don't see why that's going to change, to be honest. So we could be looking at the Australian index at a similar level in another year or two's time. The opportunity is in quality small caps and mid caps, and also in resources. That's where the real opportunity is, because it's almost certain that those sectors are going to remain buoyant, that they're going to have strong earnings growth. So to me, you want to go where the greatest certainty is. The next few years offers just enormous opportunity, more likely and larger than I can ever remember in my 3.5 decades in the market. But there will be massive volatility to go along with it. So it's going to be tricky. Portfolio analysts last week, we looked at battery materials stocks and the fact that really the best is yet to come in that space. We also looked at a very enticing stock opportunity that has already started kicking some goals in the first few days. And just the reality of using mechanical trading systems, which some people find attractive, but they've certainly got their pitfalls. That's it for this week. More information on the website, and there's my email address for anyone that wants to contact me, and I'll be back with you next Sunday. Cheers.